Well, now with us from New York, take a look where the markets go from here is Vinny Catalano, global investment strategist at Blue Marble Research. Vinny, thanks for joining us.
Thank you, Craig. How are you?
I'm doing very well. Sorry for messing up your name there in the beginning. I wanted to ask you right off the top, the seesaw reaction. I'm reading this as dipping on Syria, but again thinking that the numbers just aren't strong enough for a taper. How do you read it?
Yeah, I think that what you have is you have a situation where professional investors believe that they're in a no-lose scenario. And that is that if the Fed tapers, that's because the economy is improving. And if the economy is improving, I mean, earnings are going to be improving. And therefore, you can have the stock market go up. If the Fed doesn't taper, that means that interest rates remain low. And because interest rates remain low, that means there's still a lot of money sloshing around. It's got to find its way into various different types of investment vehicles. And therefore, the stock market goes up. Somehow, there's a little something troubling about that, no-lose scenario that I think people should take a moment and step back on. Because if that were true, then the one thing that comes from that is that cheap money is the cure-all for every possible economic disease that we have.
But Vinny, take us a little bit further into your view. What, based on your outlook, do you think the markets are in for in the next couple of months?
I think there's a really good chance that we're in the process of developing what I call what is known as a failing rally. In other words, the U.S. markets rally on up, and we're really talking about the U.S. markets because the global markets, if you were not in the U.S. markets and you were in other markets, you would think that in fact, you would know for sure you're not in a bull market. In the United States, it's marching along. It's like the generals moving out, and the rest of the world is the infantry, and they're sort of not following. So it's a different situation that you have there. But in the U.S., you had the all-time highs reached recently. Then you had this scare that took place in the month of August, and now we're getting this rallying taking place right in the teeth of what is generally a bad part of the year. So I would look for this market to have a failing rally at this point and then break down to lower levels as we move further into the fall for a variety of reasons, which I would be happy to go into.
Well, before we get into what those headwinds might be, I'm just wondering why they're different from any of the headwinds that we've seen over the past year. The debt ceiling debate, sequestration, the debt downgrade last year. The market saw through all of that and moved higher. So what's to say that it won't see through the upcoming headwinds and continue to move higher, because we are seeing earnings growth out of at least U.S. companies?
Yeah, that's an excellent point. And you've listed some, but not all, obviously, because it would take probably, another 5 minutes to list all of the issues of the uncertainty that is out there. The difference between then and now, where the market is. The market from a valuation point of view has lifted so much in a relatively short period of time that there's no margin for error at this juncture, at least I believe. And therefore, what you have is you have a market that is, by most metrics, fairly valued, fully valued. I would argue that with so much uncertainty and with the high degree of confidence that I believe, too many professional investors have, that they could zigzag this market rather rapidly, I think the combination of the two means that this market should have an undervalued level, not a fair valued level. And so by the metrics that I look at, the S&P 500 right now is about 7 to 10% overvalued, assuming that earnings and interest rates remain where they are as they are.
Hey, Vinny, I want to get into the weeds with you now. I understand there's a long-term play like healthcare and especially the ETF XLV. Explain that to me.
Sure. The thing that I think that your viewers would be best served by is to focus in not on the short-term wiggle and squiggles of the market, but looking on a long-term basis where they should be investing based upon their needs, etc. Assuming that equities belong in a portion of their assets that they have to put to work, then you want to take a look at long-term trends and themes that are positive to be invested in, and healthcare is one of them. Throughout the world, not only in the developed world where you have an aging population, but in the developing world, if you do get an emerging middle class, the need for healthcare is going to increase and increase and increase over time, and that becomes one where it's a sector that I think that benefits from a long-term secular trend that is impacting the global economy.
But Vinny, on one hand, you were saying that the S&P 500 is overvalued by 7 to 8%, and you take a look at what took the sector, the S&P 500 higher. It was healthcare. So couldn't you make the argument that that's an overvalued sector?
It is somewhat overvalued, but and if you were putting money to work right now, one of the things that I think that you can do is take a look at the ratio of the sector, what percentage that the sector has of the total, in this case the S&P 500, and just put a certain amount of money into it up to what they call even weight, not to overweight the sector right now. But we're kind of mixing two different things here. One, if you're a long-term investor, short-term market movements matter to some degree, just a matter of when you get in and to what extent you get in. But you're really looking at the longer-term play, and that's what I was trying to address with that. Would I overweight the sector right now? No. Would I overweight any sector right now? No.
Vinny, almost at the end of our conversation, but I wanted to ask you about emerging markets. Obviously, it hasn't been a good run this year, but a little strength this week. How are you seeing it playing out there?
Stay away. I believe that that's an area that you really don't want to be in. Emerging markets is in, from the measures I look at, a bear market, and I think the only way to play that would be through infrastructure and water resources, which are longer term plays that fit within that thematic area. But as far as emerging markets go, I wouldn't try to catch the falling knife.
Well, thanks for that, Vinny, and thanks for your insights.
Thank you. My pleasure.
That was Vinny Catalano, Global Investment Strategist at Blue Marble Research.